I'm going to give you guys today the ultimate two-line item portfolio, which is going to generate income and capture appreciation in any market. This is very well a all-weather portfolio, and it's only two ETFs, okay? And which are they? JEPQ from JP Morgan. JEPQ is the JP Morgan Nasdaq Equity Premium Income ETF, currently trading just below 56 bucks a share, and it pays you guys 11.12% dividend yield as of today, and it pays the dividend monthly. Now, with this one, it is important that you reinvest the dividend. Now, why JEPQ is my prime choice? Because you are going to generate income by the dividend yield, and at the same time, you are going to capture appreciation when the Nasdaq goes up. Now, of course, the downside of this is that if the Nasdaq was to shoot up, you are going to miss out on some of that appreciation. But regardless, you are collecting over 11% dividend, which is a great dividend yield compared to most individual stocks. And you are going to mitigate the risk with JPQ because it is, of course, connected to the Nasdaq QQQ. That's how they make money. They sell cover calls on half of their Nasdaq heavy portfolio. And the good thing too is that when the Nasdaq goes down, because you are going to DCA into it, the Nasdaq goes down, you are going to buy more shares of JEPQ at a lower price, okay? And at the same time, the dividend yield is gonna go up. So if you keep doing this, reinvesting the dividend, DCA into it, regardless of what the market does, you're gonna be generating income, capturing appreciation, and mitigating your risk at the same time. The other one, ETF that is going to be in your portfolio is BIL. Now, BIL is the short-term treasury bill ETF from State Street. Today is trading at about 91 and a half. And the good thing about this is that the price doesn't move a lot. In fact, you can go down 10 years and it's still trading at about just over 91 bucks a share. Now, why would I pick a BIL? BIL pays you 4% dividend regardless of what the market does. In reality, if there was to be a stock market correction or even a stock market crash, when people are gonna flock to treasury bills, well, then you're gonna have right there your dry powder to invest in your favorite stock. And you can buy more JEPQ with that dry powder. Really, you don't need to buy individual stocks, guys. Individual stocks are risky. Yeah, you can make good money if you are a stock picker, but what is really the chance that you're gonna pick the winning stocks out of 55,000 individual stocks trading daily on the stock markets around the planet? So if you stick to this one strategy, you are going to DCA into JEPQ, and you are going to DCA into BIL. You are going to collect 11% dividend from JEPQ, 4% dividend from BIL, and even if you wouldn't to do anything else, that's gonna average out to about 7.5% dividend. Now, of course, those numbers might change, but it's a safer choice to buy individual stocks. Okay, JPQ um, is great. You don't have to stick to it. You can buy GPIQ too, which is from Goldman Sachs. I feel safe. The same. They're two great companies sponsoring those ETFs. They are very well capitalized, and that is your best choice. Of course, there are a ton of Nasdaq cover call ETFs from other vendors, but I recommend you stick to those two. Also, there might be Nasdaq cover call ETFs that pays you a higher dividend yield, but they don't capture all the appreciation. It depends the way they generate income. Sometimes they sell cover calls on 100% of the portfolio, sometimes only on a percentage. Now, if I will remember, JPQ sells cover call on 50% of the portfolio. Okay. And again, they have plenty cash. They are backed by JP Morgan. The other one, BIL, is a great choice too because, guys, it's gonna pay you 4% dividend, which is pretty much what an individual stock, high dividend paying stock does. But you're gonna face the risk of the principal going down. With those two, the price it's quite stable, and the dividend is safe. Now, your task here is to take the temperature of the stock market. Okay. Now, one option that you have is to DCA into it, so you never have to worry about what the stock market does. Regardless, every first of the month or every Monday of the week, whatever fits your need, you are going to allocate the same amount of money into those two ETFs. By doing that, you are completely disconnecting from the stock market. The other thing that you can do is to take the temperature of the market. Why do I say that? Because when markets are overpriced, it seems like they're always going to get more overpriced and more overpriced and more overpriced. Okay. So timing the market is a bad deal. Me personally, I am not, repeat, a good stock market timer. So if you want to be completely independent, you might just decide to DCA into it. But you can take the temperature. You can take the temperature of the stock market. Like the end of 2025, would I say that the stock market was overpriced? I never use overpriced. I might say that the stock market is high priced. But being high priced is not synonymous with the stock market going down tomorrow. Okay. Actually, when the stock market is high priced, it's going to be more expensive, and then it's going to get more expensive, and then it's going to get more expensive. Okay. There is always a sector of the market that is going to drive it. Now we got AI, and we've had tech in 2000. We got EVs. We had nukes. We had pot stocks. It's always some. So if you are going to buy individual stocks only based on the flavor of the day, eventually you're gonna be left holding the bag. If you don't want to be worried about it, you never have to allocate your time and energy to the stock market and profit from it. The best way to do is exactly this one. So when the market is hot, you're gonna buy more BIL. So you might decide to buy 50% BIL, 50% JPQ. Okay, if the market is not so hot like it is now, I do believe that the stock market has still way to go down, and now with everything that's going on with oil prices, sticky inflation, and no one knows when the war is gonna end, and all the problems that the economy has, the Fed, whether it's gonna be hawkish or dovish. You don't have to make any of those forecasts. So right now, which the market is not so hot, but it still has a way down, I would buy 70% JPQ, 30% BIL. And again, if the market keeps going down like it's been doing in 2026, if 2026 is going to be a rerun of 2022, well, in that case, you are possibly better off wait until the end of the year to buy JPQ in a higher percentage or buy your individual stock. Now, what happens is that if the market was to get into a correction, or even we're going to experience a stock market crash, in that case, your JPQ principal is going to go down in value, but you keep collecting the 11% dividend, which is going to keep you afloat. At the same time, you are going to be able to buy a higher percentage in your portfolio of JPQ with the same amount of money, because the price of JPQ is going down. By doing that, now your dividend yield has gone up. Okay, so it could be that you are collecting now 12, 13, 14% on JPQ. At the same time, BIL, you are never going to lose principal on BIL, because those are short-term treasury bills. And notice something. I'm not just saying that you buy treasury bills. I'm saying that you buying short-term treasury bills, because if you buy a 2-year bill, or a 5-year, 10-year bill, a 30-year bill, you are going to take the risk of whatever the Fed is going to do. And no one knows what the Fed is going to do, what interest rates are going to do, what inflation is going to do. But if you stick to those two line item portfolio, now, if there was to be a market correction, like I believe we were in one last Friday, when the Nasdaq QQQ was down 10% from its highs, or even a stock market crash, now you're gonna have again a dry powder that it's gonna keep you afloat on about 0.5% of your portfolio, and you're gonna have the dry powder to buy more JPQ if you like, or to buy your favorite individual stock. Now, for me personally, I believe that this is how it's done. And even when you do buy individual stocks, you are going to have to select first, I would say, in between 4 and 6 great companies, individual stocks, based only on fundamentals. Okay, if you need to pick more than 6 stocks, you're gonna fail at this. Okay, if your stock portfolio is 10 stocks, you're better off buying the S&P 500. Look, I've been there, done that. I learned it the hard way. I would stick with JPQ, BIL, and if there was to be a stock market crash, you can use that dry powder from BIL to buy 3 or 4 maximum of your favorite stocks and never sell them. Happy trading, everyone. Thank you for your time. I hope this was helpful.